All right. Good morning. Good morning, everybody. So looks like we have Asia closed, or at least Japan. They got a holiday today. We got auctions on the front end, 3 and 6 month. And we have Christine Lagarde speaking this morning twice. And it's highlighted as a dark red. We also have one later tonight, another one dark red, but that's way later tonight. So it won't be an issue during our trading day. The two that are really lit up is Christine Lagarde with Europe. There's a threat contagion for financial crisis around the world. And, depending on what you were reading over the weekend, you might be looking towards the EU and contagion from that. Just don't forget that Bank of Japan still carries one of the biggest threat levels right now. They're changing over leadership at Bank of Japan. And like we saw last year, when a leader says something, that's often all it needs is just for somebody to say something. New leader, it can happen real easy. That's one of the biggest blindside threats that I see to the market right now that kind of seems under the radar. And it's those under the radar threats that usually are the ones that cause the most excitement, right? Because it was unforeseen. When we can see something coming, then everybody hedges it up and prepares for it, and we end up not getting a big move anyways, which is kind of what Wednesday looks like, at least so far. It's such a big event and everybody is already well positioned for it that it's kind of hard to see a big move actually making its way out on Wednesday unless it's a surprise. And they've been working hard to eliminate that surprise. Everybody's calling for bond rallies. With the way that yields dropped last week, it's not a surprise. The 2-year declining is usually a flagpole warning for, recession, the start of. The Fed is absolutely trapped. They need to continue to raise rates because inflation is out of control, but they have already raised rates enough to cause this financial crisis threat. So they're damned if they do and damned if they don't. Europe just raised 50 basis points last week, and now they're already talking about cutting rates. It'll be the same here. They're going to raise rates Wednesday. I think that's a foregone conclusion, but everybody's discussing how far that's going to last before we cut rates right behind it. And yet there's a real big disconnect because the indexes continue to go up, and at least the S&P had an inside day breakout, which we'll get to the charts in a minute, but it was inside day breakout last night and it rallied right back up off of that 3,900. Solid as a rock. So Europe is forefront today, and Europe is forefront again tomorrow. It's going to be the most dominant thing. Just keep your eye on Bank of Japan. We're not done there yet. So everything started out pretty negative last night. Asia was able to rally back up, not enough to get back into the box, but rallied up off of those lows anyway and got back into that IX10 pattern. Europe still open, managed to not only rally back up, but get back inside of yesterday's price action. So at the moment anyways, pressing against the high of day and holding a pretty steady level considering they've got, you know, speakers on deck. Looking at Brent, we had a reasonably decent rally up off of the lows, but Brent and crude still pretty negative. We're still looking at that trendline breakover opportunity, but it hasn't even begun to break over yet. And remember, we're looking for a stabilization day. It looked like March 16 was going to be that stabilization day, right? We get the move to the downside, then we get the recovery day, then we get the breakover day. But we didn't get the breakover day. So we had the recovery day. It's that green, like graveyard doji there. And then it just fell apart and down we went again. So we need a new recovery day before we're going to get this trend line breakover. And this is prime. It's a very, very beautiful prime. So, you know, if you are a little bit of a sports person, think about volleyball, right? It's best done in at least pairs of two. So one can pop the ball in the air while the other one knocks it over the fence. So this needs to be set up. This is the setup. Now we just need the follow through. It's a two-part play. It's worth noting all of the defense down here has been taken out, right? When we got there on the 15th, 16th, and 17th, tested those lows without ever cracking through it. Well, we made it through there this morning, and it doesn't matter that we rallied back up. We did wipe out that level. Now, a lot of reasons could be behind that. The big buyer that was down there may have decided that they want to buy it at a lower spot and quit buying it there. So we dropped it through and then they bought. Or they're done, that they've got their fill and they're not going to buy anymore. So now we need to watch this to see if it's going to continue to be defended at that level or if we're going to, you know, test some new lows. Front end on the auction, I'd already mentioned. We have FOMC Wednesday, which hopefully by now is not a surprise to anybody listening. FOMC is Wednesday. So Monday and Tuesday, if you're, you know, looking around at things that you are thinking about trading, just kind of keep in mind, if you're looking at a swing trade and you're going to get in right before the FOMC announcement, you're literally getting in with no idea which way the market's going to go by Friday, by Wednesday afternoon. It doesn't matter how bullish or bearish, whatever it is that you're about to trade, how good it looks or how bad it looks. When FOMC comes out on Wednesday, it will dominate and it will beat any price pattern, any technical analysis, any pivot point. Nothing will stand in the way of that. Support, resistance, supply, demand, momentum, trend, nothing will stand in the way of that. So when that FOMC announcement comes out, it's going to wipe out everything in its path. I can't tell you how many people reach out to me on Thursday after an FOMC and say, well, I got this trade and now I'm upside down and I'm getting hurt. Is there any way to fix it? Probably not. All right, I already mentioned that we were inside day breakout. We've managed to pull back inside the box. We overshot 3,900 last night in the overnight hours, and we popped back inside. Very, very strong defense down here at these lows. Between tier 1 alpha and spot gamma, they've made it pretty clear where, the put walls and the call walls are. And then with the JP Morgan collar needing to be rolled, there's been a lot of articles on that as well about the new position, the new levels that we may be in. And it's worth noting the volume this morning. Remember, we're done with all of the rolling. And some of the elevated volume that we were looking at last week, we were attributing to the roll. But we can't attribute this volume to that roll because, well, we're done with the roll. Right? We're firmly in the June contracts and there are no more March contracts. So this volume is our volume. And this kind of volume is why I even turn this silly indicator on. It's cumulative volume that starts at midnight. Doesn't really offer a lot, right? And yet what it does offer is the perspective of how active was the trading last night? How involved was it? How heavy was it? And then we can gauge that on a day-to-day basis. We're in significant levels right now. It's bordering on extreme. So we got a pretty significant situation right now where we're seeing the indexes do one thing, and then we're seeing equities do everything else. And it's not exactly making sense across the board, depending on, where you look and what you're looking at. A lot of the tells that we've been using, say a weak dollar, strong S&P, bonds going down, yields going up, S&P going down, all of these different pairs and combos and tells that we've been using, they're broken. Things aren't moving starting last week the way that we've kind of gotten used to them moving. And those correlations don't last forever anyways, right? We always got to be on the lookout for that relationship to end and then for a new relationship to begin. So we managed to peek outside of the box on Thursday into Friday, couldn't keep it. We're back inside of this bigger box. I really believe that this box is our range into FOMC from, 38.25 on the downside to 40.25 on the upside. It's a 200-point range. And if we can manage to stay inside of this box until Wednesday, I don't think it would be too much of a surprise. And if you're thinking, well, that's a really big box and that's not really helpful. Yeah, you're right. It's not very helpful at all. We already had an expectation that we weren't going to go anywhere and that we're not going to do anything. And trying to tighten it up at all, probably going to just do us a disservice. We nearly hit the full ADR this morning, which would be 38.90. We're underneath the daily pivot point, but we did manage to get back above the weekly pivot point, at least momentarily. We tend to use that weekly pivot as like an overall market bias. You know, are we overall short, long, recovering from shorts, fading off the highs? You know, where are we at? And right now we're flirting with that level, chopping about. If you look at last week, we just crisscrossed back and forth. I know that the chart's kind of messy, but here's the weekly pivot point from last week. And if you think about linear regression, least squared methods, dot plot statistics, and we just overshot that level back and forth, getting a little wider every time, right, or along the way. But that weekly pivot point remained central in focus because we're just not going anywhere. Everybody's waiting on the Fed to provide guidance, and they're in blackout mode. So if they want to provide guidance, they got to leak it through that Nick Tamaros guy. The Twitter Discord that I built is down right now because Twitter changed the way things can interact with it. I don't understand all of how it works, but I use a bot called Me6, and Me6 has published that there's something changed at Twitter and they're trying to find a way to fix it. So now you actually have to go to Twitter or use some other integration system so that you can get the Twitter feeds. Keep your eye on that Nick Tamaros guy. If they're going to leak anything, it'll be through him. But I mean, really, it's hard to see what more they're going to have to say, right? They're trapped, they're stuck. They're going to continue to raise rates because, well, they have to. And yet raising rates is very likely going to unravel something else. The good thing for them, though, is I think something's going to break globally. And it's going to reverberate around the world and give them the opening that they need to start cutting, to where they can say, well, we weren't going to cut, but you know, now that this thing has happened, we've got to cut. $10-day, 30-minute volume profile. We really don't have a classic shape unless we wanted to consider this a D. Point of control in the center. We're underneath it, and it's proving to be a significant level of resistance, but it's also going to be a little bit of that gravity point. 3,900 held. If we continue to move to the downside, we got 3840 for the low end of this. Even if we were to start to try rallying back up, 4,000 is going to be a significant level to get through. And it's hard to see that we can get through that without some form of catalyst. So a lot of the activity that we're seeing right now is due to dealer gamma hedging. And that's strong, don't get me wrong, but it's not strong enough to break through these levels. It's just strong enough to get us to those levels. We're going to need a catalyst to get through it, to get onto the other side of it. 4050 is the next area of resistance, maybe 4060, right? I'm doing a little rounding. We got a shallow area. We should move through that relatively easy, but then we would be up at the top of the box. When we're at the top, we expect to go to the bottom. And when we're at the bottom, we expect to go to the top. But we failed in that maneuver. We didn't come off the bottom and get back to the top. We got stuck underneath that point of control. And it's continued to be resistance through all of this. I posted something from Spot Gamma earlier. Let's see if I can find it. Yes. So this is looking at SPY, but they used SPX in their language. 4065 is the upper boundary for the current market range. And that the last time we went up into that level, it took a rejection on the 6th. So they're still looking at the market moving up, not because they're bullish, but because of all the dealer gamma hedging and, kind of behind the scenes, what the market makers are being forced to do, whether they like it or not. If we think about 4067, it's the top of this box, right? There's 4067 right there. Very likely this was the rejection. We can count. Nope. I was going to say we could count back to these days here, but that wouldn't be enough days because this is a 10-day. And they were talking about March 6th. Either way, keep your eye out for another test across these highs. Even just recovering back inside the box from having this inside day breakdown last night, that's pretty significant. Almost impressive. We still have that VPOC at 38.94. So if we do break down below the Globex low, we have Thursday's low, which is really, really close to that VPOC, 38.94. It's still a strong support level because of this pivot point more than that VPOC, but still 3,900, whether it's, 15 points above or below, it's not going to matter. Really, it won't. A little overshoot never hurt anybody. It's worth noting how wide the Globex is already this morning. 77 points, give or take, maybe closer to 80. And we haven't even gotten started yet. We basically came back up to where we opened Sunday night. Missed it by just a little bit, but really, it's a negligible amount. We are underneath the 10-day only by 0.25%. But it was a crossover, and we're continuing to move away from it. And 38.52 is the range for the week. The bottom edge of the range for the week. Now, because it's FOMC and everything else, I'm going to add one more level to that range. 37.56. And for the top side, 41.38. That's the 2 standard deviation move rather than just the typical 1 standard deviation move. So the range for the week is 40.43 to the upside and 38.50 to the downside. Add another 100 points lower and another 100 points higher, basically a little rounding. All right, and we're underneath the 10-week by nearly 1%. We didn't even manage to get above it. We just came up at it and then kind of flattened out. It's very likely that we're going to stay hovering near and around this 10-week until the FOMC. I'd like to say that, you know, a typical FOMC week, Monday and Tuesday and the front half of Wednesday, we don't normally do anything. Someone way smarter than me once said that the FOMC is a volatility suppressor. And I really wanted to argue against that the first time I heard it. That, what are you, crazy? The FOMC causes all kinds of volatility. How is that a volatility suppressor? But I misunderstood at first glance what they're saying. Sure, when the announcement comes out, it generates volatility. Absolutely. Who could argue with that? But as we go into FOMC, as we lead up to it, it's a volatility suppressor. Volatility is a nerd word for movement. So when you have implied volatility, you have an expectation of movement. Well, we just talked about the fact that as we go into FOMC, we expect the market to quit moving, that it ranges and that the range gets smaller and tighter because, well, we're not moving. We're all waiting on the FOMC. That lack of movement is a lack of volatility. FOMC is a volatility suppressor. It makes sense when you kind of work it all out, right? So the lack of volatility, don't let that fool you. If you're looking at VIX and it's just not really doing much, or if you're looking around at the market and it's not really volatile, moving around a lot. All right, we got the dollar breaking down to new lows. Bonds are off of their highs and not yet breaking out. Completely the opposite of the 10-year, which are off of their lows, but are not yet breaking down. Right, so these two charts completely inverted from each other. You can use ZB, ZN, ZF. The front end of the curve very likely is going to move more than the back end of the curve. VIX is still elevated, but it's not really helpful. You know, 9 months ago, if we'd have seen the dollar making breakdown moves like this, we would have seen the S&P breaking out to a whole new level. And I mean, as you can see here, we're not in that situation right now. The dollar and the VIX no longer look even remotely similar. And the moves that we're seeing in the dollar are not being reflected in the equity markets. Heck, it's not even being reflected in bonds and yields. So it's not to say that we can just quit watching the dollar. I'm not suggesting that, but don't look for that same dichotomy or seesaw teeter-totter move. When one goes up, the other one has to go down kind of thing, because that's not what we're in anymore. The NASDAQ is still holding up relatively well versus the S&P, which makes sense. The S&P has financials in it. The NASDAQ 100 doesn't represent financials. The China constituents, those China ADRs, very likely down across the board. I'd be interested to see which one of those are getting gut punched, but KWeb is down 1.8%, which usually implies that the China constituents, PDD, JD, Baba, Baidu, that those are going to be down as well. Energy and oil and gas down, financials down. It might be maybe shorter just to name the things that are up. Bitcoin nearly 5% this morning. We're coming into a level of resistance here on Bitcoin. For the Bitcoin futures, it's through that level of resistance, and it's really close to getting this gap filled. There's also a quarterly level, 29.2. This is a part of the confusion that I was talking about, where you've got all of these bullish things going on, which normally we would take as a bullish sign for the rest of the market. And yet we're not seeing that reflected in the indexes. Nat gas continues to chop. We have every expectation that it's just going to maintain these lows down here, and we could even make new lows. Right? Maybe retest that $7 area. But bigger picture, this shape of a chart, if you were to go read like Wyckoff and Dow theory, this is not a new pattern or a new shape or even a new sentiment. Right? We've seen this before. We'll see it again. The expectation is that we're going to build a base down here, and it's going to get boring, and people are going to quit looking at it because it's just not doing anything anymore. And then it'll start rising back up again. But it's going to be a long fight, very likely, not a V-shaped recovery. Gold is up. US dollar Japan is down and gold is up. That at least still makes sense, right? Out of all the things that we're seeing right now that don't make any sense, that pair group still works. US dollar Japan down, gold up. Check. We are coming into a resistance level on a lot of these equity pairs or Forex pairs. I'm going to hit the mute here for just a second. I had a sneeze sneaking up on me. That would have blown somebody's eardrums out. Guarantee it. You'd have felt that. So I had someone ask the other day, what does it matter looking at the FX pairs if you're not trading FX? You can trade the ETF of the country that we're looking at. So, US dollar Japan, there's FXY. It's the Japanese yen trust from Invesco. FXE, FXY, FXI, FXC. There's a lot of choices. They're not all very liquid, right? And some of these are going to be big overnight movers more often than not. But yeah, I mean, they are tradable. And it's not exactly the same as trading the pair. But if the bias is, say, US dollar Japan is going to continue to fade, maybe retest that 127.5, then you could look at something like FXY retesting this 73.5, right? They're inverse of each other in that relation. So 50 MA breakover with a retest of the pivot on the expectation that this already had its 50 MA breakover and is likely to retest this pivot. With the way everything is right now with tech and the banks, and if you're just looking to step out of that madness and into some other madness. So with this US dollar, or excuse me, with the Japan chart here, they were running yield control at 0.25%. They couldn't maintain control of it, and they repositioned and was maintaining it at 0.5. Now it's dropped back down. And I got to say, I was busy over the weekend and I didn't get to read any articles or any ideas on what are they going to do now. Now that it has come back down on its own to around that 0.25, are they going to try to maintain it here? Or are they actually going to let it buoy back up to 0.5%? I don't have an answer to that, by the way. I'm going to continue to look today, see if I can get some articles on this. Usually in those articles, it'll be comments made by Bank of Japan officials, right? So it's not technical analysis that's going to give us insight here. It'll actually be statements made by officials. So you're going to find those kind of answers in articles, not in the candles. We're not yet in backwardation. So what I was just looking at here across the bottom, we've got 9-day VIX, the regular VIX, which is 30 days, 3-month VIX and then a 6-month VIX. And what you want to look for are their dollar values. Not really using the 9-day for this, right? I put it on there just for a little bit of perspective, but we don't really use the 9-day for looking at backwardation and stuff. You can, it's just really, really front end. But what you want to see is a market that normally lives in contango, and that's a curve that looks like this. Things really close in time should have less dollar value than things very far out in time. And that makes sense, right? Because in the future, we could have hurricanes, war, famine, drought, supply chain issues. Nobody has any idea what could happen in the future, and that makes things more expensive in the future. Generally, it's contango. It just means everything is normal. When we're in backwardation, that curve is backwards. Things in the front are very expensive, and things farther out in time are less expensive. One thing that tells us is investors are so concerned about the front end of the curve that screw what might happen in 6 months. They're dealing with everything right this minute. And that's usually where a lot of bad decisions get made. But beside the point, we can see it, we can identify it, and it usually is a heads up signal, warning about a lot of risk. And it changes the options in the way that they're priced and the way that they're traded. We're not there yet. If the high end of the curve that we're looking at is 6 months, it's still at a higher price than the 3-month, which is still at a higher price than the 1-month. So we're still in contango, the normal curve. Now you can watch this curve and see if it's starting to flatten out. And then you can watch the curve to see if it's actually starting to roll over on the far end, looking at, instead of these close in, you can actually look at like a 1 year and farther out. So gold's kind of like a little runaway market at the moment, but we still have a significant level of resistance to deal with, that 185 and then the 190 area, 191 maybe. And the expectation is this is going to continue to go up as long as the dollar is falling, but more important, US dollar Japan is falling. And I'm seeing a concerted effort in emails and advertising and media about buy bonds, buy bonds, buy bonds. Now, while I can't disagree with them, it's starting to feel like they're on a campaign. It's called sold to you. If firms want to get out of something, they need somebody to buy it. So while the argument to buy bonds does make sense with the yields falling and bonds rising, and it's such a drumbeat everywhere that it's starting to get a little suspicious. So my own little note of caution there, if everybody is telling you to buy it, don't buy it. All right, XLF. The three cousins, JP Morgan, Bank of America, Wells Fargo, these three generally all have very similar charts. And we can see that JP Morgan has stepped away from the group. It does not look like these other two. So a little note of caution there. Either these other two are going to start to look like that, or it's going to start to look like these other two. Right now, it broke down. And Wells Fargo broke that range. It started to fade a little bit, but they're not similar, and that's not normal. So I would expect these three to reprice, get on the same page again. And then the next group, Citi, Goldman, and Morgan Stanley. Now, with XLF or with all of my sector ETFs, the names that I show here are the highest weighted names in that basket of stocks. But you might want to take a different approach. Divide these up into what they represent, right? Not necessarily the names that are in the XLF, but financial names in general. Break the trading desks apart, right? Schwab, Fidelity, TD Ameritrade, IBKR. Break those apart, set them aside, look at them in their own group, and then say trading institutions like JP Morgan, any of these banks that have a trading desk, break them aside. What you do want to get rid of in the financials, which is one of the reasons I don't use the XLF, is like those insurance names. It's not that they're not important, they just don't fit the argument right now, right? They don't even help with the analysis or the perspective of what's going on. And the XLF has those kind of financials in it. Insurance is in the financials category. So XLF isn't really all that useful unless you pick the highest weight names in there. And it's such a broad basket that you get a hodgepodge of different financials all mixed together, which is why generally I go in and look at something like KRE. This is regional banks, and while they're not generally liquid enough for my taste, I don't trade them. At least I don't trade their options. These are the names that are getting whacked right now. And this is the industry that's getting hit. So far this morning in the pre-market, a lot of these aren't even getting any liquidity. They're not even getting any trades. First Horizon's getting a little. And Fifth Third Bancorp. But what we can see is they're either flat or slightly up. And that's not very encouraging. There's just not a lot here yet. So we can see a lot of these have rebounded off of the lows. Couple things to keep in mind. Some of the rebound is because of what the liquidity injections from last week, the Fed coming in, doing that under the table QE. There's all kinds of under the surface stuff. But then there's also just technical analysis that says linear regression will pull this back in the other direction like a whiplash. Think of a bungee jumper, right? When they get to the edge of the bungee, it yanks them back in the other direction. All of these names fell far enough that they very likely would get whipped back in the other direction, not because everybody suddenly turned bullish, but just from mathematics alone, it's what happens with markets. So you can use that drawing tool regression line, and it doesn't matter, if you start with your mouse on the candle or not. It's where on the chart to the left that you start, and it'll do the rest, and then where on the right you stop. It's a regression line. That was a stall. Run through again, another stall. Now, generally the way this works, if you get reciprocation. So if you get a 3% move on one side, you very often get the same 3% move on the other side. If you get a 0.5% one way, you generally get a 0.5% the other way. It's usually how it goes. And by the way, that's the same thing with RSI and oscillators too. If the RSI gets to 90 on one side, it's very likely going to go to 10 on the other side. This is the way it works. So looking at this on the weekly, you can see KRE is coming into this lower level. Like, I think we can turn this regression line into a regression channel. Had my chart in log scale, so I had to get out of that. So you can see that we're outside of the channel. This is why I think we're going to go up, right? Because we're outside of the channel. We're outside of the box. So, one day, maybe two, short term, we may be looking up, looking long on the financials, but not because everything's getting fixed or because we're suddenly bullish or anything like that. It's just a rebound. Usually there would be a support level that we would hit, and this would be a rally off of support or a bounce off of a support, rally into resistance. That's the phrase that you want to kind of keep in mind, right? Bounce off of support, rally into resistance, sell the rip, don't buy the dip, right? It's kind of the idea behind it. Two ranges on SPY this week, 375 to 4, we'll call it 425. It'd be this higher end from August of last year. Maybe we bring that in the other direction since we're talking about two ranges. 410 to 375. That would be your smaller range. And then your bigger one will be from the October low to the August high. That'd be your second one. And if that seems like I'm reaching, I'm not. I'm not reaching even a little bit. That is well within the range of what we could do. $13 is the weekly 1 standard deviation for this week. If we round and say that we're at 390, I mean, that's 1 penny. That would be 403 for a 1 standard deviation to the upside, and 377 for the downside. But that's just a 1 standard deviation, and that's what they would consider normal. So a 2 standard deviation would be much bigger than $13. So here we're looking at SPY. You go to the Analyze tab. In the gray, we can see a 1 standard deviation. And we want to look at it for Friday. So we change the date up here. We can use the 25th. That'd be Saturday, because it's all end of day data. Set slices. So that's 1 standard deviation. 401 and 378. But you can change this probability to a 2 standard deviation. $413 and $367. Well, those sound like the numbers that we just got from out here using implied volatility. Three standard deviation using this, 425 and 357. Now this cone is based on monthly expiry. So from our current location to the April expiry, 453 and 335 for a 2 standard deviation move. Now I point out those levels, not to really scare you, but to get you to think about maybe some out of the money stuff. Everybody's looking for this big move on Friday, or excuse me, on Wednesday, which means we very likely won't get one on Wednesday, but that's from FOMC that they're looking at. I think the potential for a big move is still on deck, but not from FOMC, from the FX markets, whether it comes from an EU bank crisis or from Bank of Japan throwing fireballs. So either one of those two could very easily engulf and just completely wipe out anything that we could get from FOMC. And the big move is absolutely on deck, and it's not all to the downside. And if we're talking about risking 10, 12, 15 cents, I mean, that's like lunch at McDonald's nowadays. I wouldn't want to build a whole portfolio full of YOLO plays, but they have their time and a place. So my advice, anticipate range. When we get to the edges, those are opportunities to trade a reversal. Just remember that when we get to the edges, we're very likely not going to stop right on the pivot point for a lot of reasons. One, liquidity resides on the other side of the pivot, so we normally are going to overshoot anyways. But even with that in mind, the current volatility would very likely have us overshoot the ranges anyways, just from like drift, right? Kind of like imagine driving fast in your car. The faster you go, the more you drift when you try to turn. So anticipate range, play the edges for reversals. And if we do break down, it should be across the board. It should be everything, not tech versus finance, which we've been seeing a lot of, tech going up, finance going down. That's one versus the other. It should be everything goes down or everything goes up if we're going to have a breakout. So when we do break out or break down to those edges, your first bet should be it's going to reverse, especially if it looks really, really strong. Because it's going to look that way to deceive you, to trick you. If you play the reversal and you turn out to be wrong, and we actually do break down or break out, there's a lot of room to move. So you can easily just close the trade you're in, open a new one, and take the other side of the trade. Out of the two, the NASDAQ has more to give up in a downside move than the S&P. But in a rally, the S&P has more to reclaim than the NASDAQ. So something to keep in mind on that, right? The VIX is more helpful now than it has been in almost a year. So keeping your eye on the VIX is really going to help you out. It's going to help you out more than the dollar is. That's for sure. Over the last year, we've basically ignored the VIX and watched the dollar, but now we got to flip that back around again. If you look at liquidity, Tesla is still more liquid right now than nearly anything else, which, maybe says something. But we want to watch liquidity, right? It's one of the reasons that we watch Bitcoin so much. It's a liquidity tell. So with Tesla, we're very close to an inside day breakout. We're still IX10 from this candle back here on 314, but I'm using the wick low at 175 and the wick high at 186. That's the zone that we're in. So if we do get the inside day breakout, look for a little bit of support around that 176. And if we break that, then focus on the pivots all the way down. 175. 173 and a half. 168 and a half. And 164. And really, these two are kind of close together. You could knock out that 175. Kind of carry this over. 173. We got the TRB. We got the breakover, but it completely stalled and fell apart, right? There was no reciprocation run back up to the other side. There is a gap to close. At 160.27. So if we get below that 164, then we're very likely going to go to 160. And as you can see, there's absolutely nothing down here. So a break below 163 puts us in an air pocket drop. This is a beautiful rollover pattern. A swing trade in Tesla back to 107 is not out of line, with a stop along the way at 135. To the upside, keep your eye on 183.5. If Tesla starts to bounce off of support and make a run to the upside, 183.5 is the 50% of this candle. For that swing trade to the short side, I would give the trade a little bit of time. You can see how it clusters. So you get the rollover, it reciprocates right back down to where it was, and then it sticks. Well, the rollover's just gotten started. And these are weeks that I'm looking at. So from this cluster, we have drop, base, rally, base, drop. It took a month to make this move. They say stocks go down faster than they go up. I would use at least a month. Now there's two ways to play it. If you did a call credit spread at the money or near the money, it's cheaper. I know everybody likes to go out of the money and get far away, but that gives you a skewed risk to reward. And while it feels safe, if you get run over, it's going to lose more than all the other trades. So an at the money credit spread gives you more of a 1-to-1. And if you're wrong, it won't lose very much before you get it closed if you are out farther on the time curve. So say 2 months out at the money credit spread. And if we rally back up, you could shut it down and probably won't even lose 25% of the whole position. That's one way to go. And all you need in a trade like that is for it to close at expiration lower than your break even. So it's not a big ask on the other side of it. And that's fine. But if you were to go out of the money and put on a put debit spread, you can make that a lot cheaper. And if you're wrong, well, you'll lose less. But then you can also widen that spread out. I remember reading an article by Tasty Trades where they were interviewing one of the Johns. It was John Euler or one of those guys, right? One of those big names. And of course, I'm trying to say his name, and so I can't remember which one it was. But he said one of his biggest trades was a Tesla trade. And he had put on like a $100 wide debit spread. And he said that was his normal, was these $100 wide debit spreads. Now, Tesla's done a stock split. So, you know, back when he did it, Tesla was more expensive. But what got my attention is he said he was commonly using these $100 spreads. And I thought, my goodness, man, I've been doing, you know, $5 wide and $2.50 wide, and this guy's doing 100 point wide spreads, and that was his normal, his default, like go-to is 100-point spread, which is odd because it was on Tasty, and Tasty is a drumbeat on keeping the position size relatively small, and that going above $10 wide spreads really just doesn't gain anything from the Greeks. So his trade was kind of just the opposite of what they always say. We're looking at an out of the money in Tesla 2 months out, so say around May. Let's filter these a little bit. So that we're only looking at monthly expirations. We can see how volatility is projected to drop off as we get farther out on the curve. And that's really not normal, right? Normally, volatility goes up the farther out on the curve you go. Well, I really don't want to go out to November, which is where the curve looks like it starts to turn around again and begin going back up. That one's kind of an outlier. But I don't think May is out of line. So here's a 40-point wide spread for $1.80. Wow, that's cheap. Or a 20-point wide spread for 78 cents. Now, there's always the argument, should we use a wide spread or use a narrow spread and then put a lot of them on, right? Because you can get 10 of these, that'd be $90. It's $5 wide. So you're risking 10 cents for a chance to make $4.90. We know we don't make max profit, so $4.90 isn't really a realistic number, but $3.90 is. This is out of the money, so if you're wrong, you're very likely going to lose all of that 9 pennies. But it's 9 pennies, so even if you just did one of these, your max loss, $9 in commissions. I would probably widen it out a little, at least a little bit, right? Here's $10 wide for 50 cents. That's a really nice rollover on the weekly. I mean, that is just a very clean, very beautiful rollover. I would have liked something like, an evening star reversal, or maybe something. And all we got is this bearish Haramni, which I don't know, maybe I'm saying that with a little bit of disappointment. That's still a reasonably decent trigger. And so far we've had a nice follow through. So, maybe I'm just being picky. Bearish Haramni. All right, so Microsoft had that runaway market last week. This thing ran me over. Just absolutely. I went short on the tag of this trend line, and it took me out. Just wiped me out. So now we closed above 276.76. That was that kind of line in the sand. And we're still above it this morning. Certainly down a little bit from where we closed, but not by very much. It needs to hold that 276.76. If we break back inside of that box, we're very likely going to retest this lower trend line. And marking 50% of this candle would kind of give you some targets. 264.5 wouldn't be a bad spot to buy a put debit spread if we can break below this hot pink line, this 276. All right, so a break below that offers us 264.50. A full reversal would take us back down to that 245, which is such a seriously strong line in the sand that I don't think we're going to get through that very easy. First, we need to get back into the box. Be careful because this is a cup, right? And cups generally get a handle on it. So if that's true, think about a handle. It would pull back first, and then it would continue on. It would be this cup and handle. So watch for a fake out where it fades back some and then rallies. On how far it should pull back, you know, I've seen a lot of articles that talk about breaking this into, say, 4 parts. And it really shouldn't come below that 75. I've got 78 marked, but it'll do. It shouldn't come below that if it's in a pullback. If it breaks more than that, you kind of got to argue that it's not a pullback, it's actually a change in market sentiment. So that's not real helpful because we wanted it to get to 261, and this says it could pull back all the way to let me get one of those out of the way. I think I'm getting the numbers mixed up. $267, or excuse me, 270. It should not pull back more than that if we're going to keep our bullish bias. And if you're bullish, the target would be 292 and then 307 if you're bullish. If you're bearish, a break below 276.76 offers us a move to this trend line. With 271 as your downside target, or at least just that trend line. Make or break in Apple. Watch for a fake breakout. So we're looking like maybe an island reversal or a fake breakout fast failure. Be a hard jump up to like 158 and then a drop. $157.5 is your critical line in the sand. I really don't see that it's going to be able to get above that unless the market does turn bullish. All right, way late. Got to go, guys. Everybody, be careful, be safe. Have a good week. Watch those financials. The FX pairs.